Hi, this is Dave. It is Saturday, January the 21st, 2012. I recorded a video the other day talking about the Dow futures, and I just wanted to follow up that video with a little bit more detailed information on the sister markets, the other stock index future markets that typically tend to move with the Dow. Now, I did note those markets, and I did note a couple of interesting things about them and wanted to draw out the comparisons in those markets. So here's the Dow, and this is what we were looking at the other day. We had what I call a Darvas Squeeze setup. It is a setup that I sort of came up with through my market studies, learning various things about different indicators, different market techniques. I didn't create the Darvas boxes, I didn't create the squeeze, but what I did was through my own observation, I kind of put the two together and dubbed it the Darvas Squeeze, and found that when the two setups come together, a break of the Darvas box and a firing or potential firing of the squeeze indicator, the two forces, if you will, combined together, which I've dubbed the Darvas Squeeze, seem to be a lot more powerful. You get a lot of Darvas box breaks that that can fail from time to time, but when you actually have a fresh squeeze in play with the break of support or resistance of the Darvas box, you typically have much stronger moves, and they are the only kind of breakout plays that I will consider at this point in my trading career, because buying breakouts or selling breakdowns typically don't work very well on their own, in my experience. Now, what I'm showing here is not a recommendation to buy or sell in any way, and we are not providing advice per se. But what we are doing is just highlighting some concepts here that may be of interest to other traders, and just want to talk about that in an open dialogue. So what we're looking at here is this is a weekly chart of the Dow futures, which we looked at the other day. We had a break of the Darvas box, long signal, pull back to 21 EMA support on the weekly, substantial pullback, and a move higher. Let me just get a drawing tool here. So basically what you had was a break here, pull back here, test of resistance, and then a move higher with potential targets up here somewhere. Potentially, 13,500, 14,000. We don't really know because we can't tell the future in trading. Now, from this perspective, you have, as I mentioned the other day, you have everything in alignment in terms of your bullish indicators here. So you have the Hakanashis are blue, the squeeze momentum is blue, and it fired off as the price action was breaking the top of the Darvas box. So then you already had a MACD crossing over. You're good here. And you have this trending indicator. This is an indicator that I developed based on, I won't get into the details of exactly how it works, but it basically looks at the price action, and it determines if the price is going higher or lower, and it determines the overall trend. When you're blue and above this zero line, you're bullish. When you're red and below this zero line, you're bearish. So if you notice, we had a pretty decent sell-off before, and we had a short squeeze signal here. Now, when this broke, this short signal, it broke and it hit the target fairly quickly. Now, this Hakanashi bar probably wouldn't have formed red while it was in progress. You only had a one dot squeeze here, which didn't really give you much of a heads up. But this indicator, the Darvas Squeeze indicator that I programmed up for the charts, still fired that signal when it happened. This indicator here for radar screen. They work similarly, but they're two different separate and different indicators. This indicator here works on radar screen so that you can see, an overview of all the different markets, all the different time frames, and this will change in real time as conditions change. These indications here, each row, like an Excel spreadsheet, is a separate chart. So this would be like a 60-minute chart, a daily chart, a weekly chart. Now this is just a function of TradeStation. It is one of the unique capabilities of TradeStation, the radar screen functionality. It's really great for reviewing lots of different markets. Now so that's the radar screen indicator. Now the chart indicator works specifically on the chart, and it will print these values when things fire off. Now on that basis, you had a short signal here. Because this is real time, it will no longer show it, but the chart indicator shows the history of what took place. So looking back in history, you had you didn't have necessarily a bearish scenario, but the Darvas Squeeze did give you a heads up it was going lower. You still had the trend being higher. So this was a kind of a counter trend trade at the time, but it was still a significant move. And it still played out nicely. It still hit full targets. It's interesting to note actually that a lot of Darvas box trades, Darvas Squeeze trades, once they actually hit the full 1-to-1 risk to reward target, you see that there's quite a bit of support that comes in, and this is fairly typical of this setup. So now we're in a bullish scenario now, and we had a long signal fire, which we talked about the other day. We had confluence also on the daily chart, and we still haven't hit the potential targets there. This fired around 12,250, I believe, is what we're looking at. Now let me clear off the chart and take a look at the other stock index futures. Now it's interesting to note that the Dow appears to be the strongest. If we take a look now at the S&P, the ES stock index futures, you can see on the weekly chart, for example, it followed suit, but it's not as strong as the Dow. Now you had the squeeze here, you had the bullish indications here, although this kind of pulled back down to the zero line, and you can see that little bit of red there. It looked like it was going to go short, but then it just wrapped right back up from the zero line, and when it broke out, it fired. It met the criteria for a Darvas Squeeze setup, according to the rules and how I've described the setup. So if you look at the S&P now, full 1-to-1 risk to reward is, or rather full width of the box projected outwards, has a target of 1507.75 on the ES. So the S&P has it has followed suit with the Dow. It's formed a signal that lagged the Dow. So it appears that the Dow was leading the stock index futures, which is a little bit strange, but nonetheless seems to be the case. And you can see that this signal fired 1 week ago. So if the stock index futures are going to continue moving higher, the S&P seems to have more room to move, for lack of a better description. It seems to have more upside potential. Now if you take a look at the actually, before we move on, if you take a look at the daily chart, you can see that a signal formed as well. You had a 1-dot squeeze, bullish indications on the MACD and the trend, and on the Hakanashi. And you can see that a signal formed here, printed on the chart at 12,000. I'm thinking the Dow, my apologies, 1,266 and a quarter. And you can see that, the target on the weekly is 1507. Let's have a look at the target on the daily, 1391. So this is a shorter term target. This is a more achievable target. The weekly target obviously is to catch much bigger moves. We don't know if that's going to happen, but it is a possibility. Now let's have a look at the Nasdaq, and the NQ futures here are looking like they're lagging the most. Okay. Now if we have a look at this, we're still in a squeeze. Now we just printed a long signal on this closing bar this week. So when the bar closed on Friday, we just printed this signal here. So the Nasdaq appears to be the weakest index compared to the Dow and the S&P futures. So if we look at this, you can see where the targets are, and if we look at the daily chart, if I can find my tools here, the daily chart didn't print a signal on the chart because the squeeze had fired so many bars ago, and I have the indicator set, to only print a signal if it's fired within, I believe, the last 5 or 6 bars, because you don't want a signal, when we're too far into the squeeze, because it can run out of momentum. So you did have a squeeze, it did fire, and it did break the top of the Darvas box. So depending on how the indicator is set to to trigger the signals, this is potentially a valid Darvas squeeze here on the daily. So you do have some confluence here. On the weekly chart, you have a signal that just formed, and as I mentioned, it's interesting to note it just formed. Bullish indication on the Hakanashi, bullish indication and momentum on the squeeze. It has not actually fired off yet, and the momentum is actually quite high, considering that it hasn't fired yet. The dots are still red. Now the MACD is crossed over, and the trend indicator is bullish. So out of all of the stock index futures, the Nasdaq appears to be the weakest, but it also potentially has the most room to move. The S&P, if I can just flip back to the S&P. Okay, so just flipping back to the S&P here for the third time. We're looking at, they're fairly close. It seems to be about a week ahead. And that is sometimes typical. You do see some markets leading the other. I'll just flip over to the Dow quickly. The Dow is obviously leading, at least in terms of this setup and in terms of giving a heads up to the overall direction. The Dow did obviously lead. That's the index that I usually watch. That's not always the case, but it did provide a good indication, and it did provide a good kind of heads up to where the indexes were going, which brings up another interesting point. It's always a good idea to look at what all the stock index futures are doing. Although they usually move in tandem, you can sometimes notice divergences between the different stock index futures, and they will give you a heads up as to, okay, maybe the Dow is leading, maybe the Dow is going to go higher, will it drag the other indexes higher, or is it going to roll over and die a terrible death? So that is something that you do want to sometimes take note of, and just keep an eye out to see which indexes are leading. If there's a potential move higher in one, are the others going to follow? Are they all going to roll over and die? Are there divergences? Are they moving together? Is there kind of confluence between all the major indexes? So that is a good way to kind of stay on the right side of the market, or at least figure out if you're if the move is real or not. So that's just a quick look at at the stock index futures, together with the analysis of the Dow from the other day. And interesting to note the the laggy kind of sister indexes, and potentially they have more upside, and potentially more upside than the Dow does at this point in time. So that's really interesting to note. Now, from another perspective, in terms of other markets, the bonds just printed a recent weekly Darvas Squeeze. They've been kind of choppy, but it's kind of unusual that the bonds are moving higher at the same time as the stock index futures. Usually, traditionally, they move opposite of each other. Money's flowing into safety, money's flowing into more risk in terms of the stock market, or at least that's the way a lot of analysts, a lot of pundits in the past have described it. If you look at actually what's going on here in the bonds, a lot of people are calling for lower, much lower bonds, which would denote much higher yield rates. So in other words, if the bonds are going lower, the interest rates are going much higher, and vice versa. If the bonds are going higher, interest rates are going lower, because the yields are less. So if you look at this, we had a weekly Darvas Squeeze fire on the 5-year. This is the 5-year now, and it's interesting to note that the MACD is actually lower. So you've got a bit of a divergence here. You've got momentum is waning here on the weekly chart, and you've got the squeeze, which just fired here. You've got bullish bias here on the trend indicator, bullish bias on the Hakinashis, declining momentum here on the squeeze, and you've got already a crossover in the MACD lower, which is a little bit unusual. It'll be interesting to note, if this is going to follow through and move higher, hit the targets, or if this is kind of a fake out and is going to, potentially roll over here and die. A lot of people have been expecting a bubble in bonds, and at some point, expecting them to, kind of roll over. These are unsustainable low interest rates. But you've got to follow your signals, but at the same time, when you notice divergences like this, it's interesting to note and something to keep an eye out for. Now, if we take a look at the, let me just clear the screen here, and if we take a look at the, let's take a look at the 10-year. Let's take a look at the 10-year here. So the 10 years in a bit of a similar situation where it's fired an initial long signal. We're in a squeeze, which denotes that we're going to get some movement. We can only stay quiet for so long until we return to volatility. So we've got potential long here. We've got bullish signals. But if you look over here, we've got the MACD rolling over. We've got momentum on the squeeze declining. So this is interesting to note. On the daily chart of the 10-year, and we had this on the daily chart of the 5-year as well, you had a breakout and then a pullback. But if you notice the pullback is below the 20 period or the 21 period exponential moving average. Now, typically from a daily perspective, from a daily basis, you don't want to be long when you're below the 20 period moving average. Now, that's kind of my rule of thumb for all markets, that if I'm trading based on a daily chart, I don't want to get long below the 20 period moving average. I actually want to be above the 20 period moving average, and I want to buy pullbacks to the 20 period moving average, with the expectation that it's going to bounce. Now, we're above the 21 period moving average on the weekly chart, But it's not unusual to actually get a pullback to the 20-period moving average once you see a situation like this on the daily chart. Get a pullback to the 21-period moving average on the weekly chart, for example, and look for support there. Now, from this perspective, that could mean that bonds are going to go a lot lower before they go higher. And this could be a similar situation as we saw in the stock index futures, where we had an initial break, pull back all the way to the 20-period, and then a move higher. So the safe trade on this, from my perspective, and if I was going to trade this, I'm not sure if I will yet, but if I was going to trade it, I would probably wait for the pullback here to the 20-period on the weekly chart, and then look to see signs of strength. So either buy it on the way up, or buy it when it actually breaks the long signal again. So for example, 131, the 131 level, if it comes back up and it breaks resistance again, then just go with it. So that's one entry technique that can be looked at. I'm a little bit hesitant at this point because you've got the MACD lower, you've got some divergences, even though everything looks positive. The 60-minute chart rolling over is not a big deal. The safe trade to do if you were gonna swing trade this, I think, would be to wait until this goes back into a bullish situation, which would happen, if these other things play out that I just described. So that's not a big deal, but you definitely wouldn't want to go long when the 60-minute chart is negative. You want a little bit more alignment, and you wouldn't want to go long here below the 20-period. At least I wouldn't. So that's something interesting to note for the bonds. Now let's just take a quick look at the 30-year, and then I'm going to wrap this up. Let me just clear the screen, turn off my drawing tools here, and where are you, 30-year? Here you are. So the 30-year is saying we have a potential breakout. We're in a squeeze. So the 30-year is less, it's kind of in the middle of its range on the weekly chart. It's very sloppy and choppy on the daily chart. You've got, some erratic squeeze signals, fire, back into squeeze, fire. The MACD is kind of all over the place. So you're just really in a sideways consolidation here on the daily. And on the weekly, you're kind of in no man's land here, consolidating as well. So the 30-year is a little less telling. You're negative on the 60-minute chart, and which is about the same as the 60-minute chart, or the 5 and the 10-year. So we're already around 23 minutes. This is a long video. I'm going to wrap this up, and I'll be back on another day to talk about some other markets from the Darvas Squeeze perspective. In terms of what we've reviewed today, this is some interesting stuff going on, where you're getting, it's almost telling a story like, either the stocks are going to go higher, the stock market, or the bonds are going to go higher, and it looks like the bonds are going to go lower and the stock market's going to go higher. But there's no guarantees in life or in the market, and anything can happen. So it will be interesting to see, where we go from here. Jumping out a couple of weeks into the future. So good trading. I hope that helps, and have a great day.